Okay, so good evening, class. Our topic now would be capital budgeting, and capital budgeting would be part of part two of the CMA examination. So, just to be clear, this topic is under your RCMA 4 class and not your RCMA 1. Again, this is for RCMA 4. Capital budgeting is a topic for your part 2 of the CMA examination. Okay. And in the uh, material given to you, before the practice questions, we have here possible essay questions that could be asked in this topic. And the very first one here is, of course, the definition of your capital budgeting. So it's possible for you to be asked highly objective questions in the exam. It's possible that you would be simply asked to give definitions. So it would be good if you'll be prepared for such kind of questions. So in this topic, you could be asked to define capital budgeting. And here, capital budgeting is the process of making long term investment decisions. It is a decision making process that enables a firm to evaluate the viability of a long term project and whether it is worth undertaking. Then, in the answer given here in your material, I've shown here the stages in capital budgeting. Okay, we have here the identification of the projects, the search, evaluation, selection, financing, and implementation and control. Others would include post audit as part of the capital budgeting process or the stages in the capital budgeting. So it's possible that you will be asked what are the stages in the capital budgeting process. Okay, but in case you will just be asked for a definition, might as well incorporate the different stages in the definition. So you could say that capital budgeting involves the evaluation and selection of investment projects. Okay, so it would work to your benefit if you will be able to remember these stages in the capital budgeting process. Okay, so if an essay question will be asked for capital budgeting, the definition of capital budgeting would be a good candidate. Here, give examples of key points in evaluating investment cash flow. For capital budgeting class, cash flow is king. It is the most important factor to consider. It is the most important consideration in determining whether a project should be accepted or not. We will be using cash flows. Okay, and I do not expect you to be able to provide all of these. Okay, but we'll just try to go over these important points in evaluating investments. If you will read letter A and B here, it simply tells you the importance of cash flows or the importance of cash. We simply follow the cash. It does not matter whether this cash is represented by a revenue or not. It doesn't matter whether an outflow is represented by an expense or not. What matters is whether it results in a cash inflow or a cash outflow. So here you would see that income statement items that do not affect cash, such as depreciation, expense, amortization, expense, gains, and losses, are ignored in cash flow analysis. Okay, but you also have to be careful because some expenses, no, most of these expenses would have an impact on your tax expense, and your tax expense will have an impact on your cash flows. Okay, so while the expenses themselves, the non-cash expenses themselves will be ignored, but you have to take into account the effect of these expenses in the amount of tax that will be paid with cash. Okay, so non-cash expenses are to be ignored, but again, do not forget to take into account the effects or the impact of these expenses and other gains and losses in your taxable income and ultimately in your tax expense. Okay. Uh, in letter B, it says here that All items affecting cash flows must be examined regardless of whether they are revenues or expenses for the accounting period. Okay, so again, we simply follow the cash. Okay, and the another important consideration in uh, capital budgeting is the treatment for your sunk costs. Very simple. The treatment for sunk costs would be that they are to be ignored. Again, there will be a lot of questions in the practice questions about your sunk cost, but really this is not a difficult matter. Sunk costs will be expensed. Sorry, will be ignored. Okay, because they should not matter in your future decisions because they have already been incurred. They can no longer be recovered. Okay, and here, uh, together with your sunk cost, you could also be asked for the treatment for your opportunity cost. Okay, opportunity costs will be included in the analysis of your cash flows. Okay, if you will have to give up something, then you will have to include that as part of the cost of a project. Okay, you will make sure that the cash flows that you will get from the project will be able to cover any opportunity cost that you will have to forego. And then you have your net working capital. Aside from capital expenditures, you would be expected to make investments for working capital for current assets so that you will be able to operate the capital project. Okay, so normally your total investment would not just be composed of the uh, capital disbursement, but it will also include uh, investments in working capital, amount of money that you would need for you to come up with the working capital needed to operate the project. Okay, so aside from your capital cost, you will have the opportunity cost and your working capital investment as part of the cost of your total investment. Okay, and then here you're in letter F, you are reminded that you will have to take into account the effects of inflation. But this would not be a big issue because in our uh, in our capital investment analysis, we will be using a normally we'll be using a hurdle rate, which we would use to uh, which we would use as a measuring stick, as a tool to determine whether a project should be accepted or not, whether we should be investing in a particular project or not. And the hurdle rate that we will be using will already take into account inflation. Okay, for your cost of equity, for your cost of debt, they will already include inflation premium. The cost of debt and cost equity will have an embedded inflation premium. So that means the hurdle rate will already take into account inflation. And if we'll be using the hurdle rate, then that means in our decision, we have already taken into account the effects of inflation. Okay, so just if you are asked, is inflation considered in the capital budgeting process? The answer would be yes. Okay, here depreciation expense, we already know that it will not be part of the cash flow analysis because again it is a non-cash expense. But again, remember that this expense will have an effect on the tax expense. Okay, so uh, you will have depreciation expense, and if you will have depreciation expense, that would result in lower taxable income, and if you will have a lower taxable income, then your tax expense would also be lower. So in fact, this would give you tax savings. And the tax savings from these expenses will be considered in the capital investment analysis. Okay, you can take care of these other points that I have prepared for potential essay questions. Okay, please expect again definition of terms. You might be asked for the definition of an incremental cash flow for sunk costs and opportunity costs. Okay, and you might be asked to compare accounting profits and uh, cash flows. Again, they can be different, or they would normally be different because your cash flows would include uh, amounts even though they do not represent accounting income or expenses yet. Okay, what we do is we simply determine whether there is an inflow or an outflow. Okay, but again, if ever it comes out, wherein you will be asked to define sunk costs and opportunity costs, it would be unforgivable for you not to be able to give the correct definition. Okay. So what's the importance of the changes in the net working capital in capital budgeting? Changes in net working capital. Okay. Net working capital is your current assets less your current liabilities. The changes must be considered in the initial cash flow of the project, as funds are often needed to initiate the project. These cash outflows are not included in determining accounting profits, but are a resource that needs to be funded. Okay, so again, the changes in net working capital would be part of the initial cost of the project, but you have to take note. This would also be a source of inflow in the last year of the project. Okay, you will put up this investment in your working capital, but by the end of the project, you will be recovering these current assets, this working capital. Okay, so this is one of the rare scenario wherein a type of investment cost would be an outflow at the start, but will later on become an inflow at the end. Okay, so this would be relevant in determining the free cash flows for the start of the project and at the end of the project. Okay, here I included the definition of hurdle rate because in the exam that I took, we were asked to define the hurdle rate. Okay, so the hurdle rate, which normally be which normally would be the weighted average cost of capital, okay, will serve as the minimum required rate of return of any project. A project should not be accepted if it will not be able to provide a rate of return that would at least equal the hurdle rate. Okay, so basically, your hurdle rate will determine how rapidly the value of the dollar decreases out in time. Okay, so you'd only accept projects that will have a higher rate of return than the hurdle rate. The hurdle rate is the rate that the project must be able to hurdle. The project must be able to overcome or surpass the hurdle rate. Okay, you can expect questions to be asked on sensitivity analysis, simulation, scenario analysis, and Monte Carlo analysis. Okay, so you're being told now that this could be asked, and if ever you'd be asked for the definition of these four, okay, again, it would be unforgivable for you not to be able to give the definition of these alternative approaches. Okay. As we've mentioned earlier, we will be using the hurdle rate, but it's possible that you will be using an adjusted hurdle rate. So for risky projects, you could have a higher hurdle rate. For less risky projects, you could have a lower hurdle rate. And that makes sense because if a project is risky, then it should give you a significantly higher rate of return. Okay, so the use of adjusted a WACC or hurdle rate would help you uh, choose the correct projects to invest in while taking into account the level of risk. Okay, always remember the principle of high risk, high return. Okay, make sure to go over the other possible essay questions I have identified here. Okay, in the Wiley and the I think in the Wiley test bank, there are a lot of questions on post audit, so make sure you would know about the post audit. Okay, in post audit, it is an audit that is conducted after the capital investment project to compare actual results versus expected results. Let's start with the practice questions. Number one, okay, very easy. It's a giveaway. The overall process of evaluating and selecting profitable long-term investments consistent with the firm's goals of shareholder wealth maximization is known as capital budgeting. I remember when I took the CMA examination, if I encounter a question, a multiple choice question that basically gives you the definition, I try to write it down in the scratch paper that would be given so that I could use this definition if ever it would be asked in the essay portion of the exam. In the CMA exam, you will not know yet the essay questions. You will have to pass the multiple choice questions first for you to proceed to the essay portion. Okay, so anytime I encounter definitions, I try to write them down with the hopes that I would be able to use them in case an essay question would come out involving those topics. Okay, so while I was able to do this in one of the exams, none of the definitions I wrote down uh, was useful. The questions in the essay question were different, were from uh, topics that are different from the ones I have taken down. Okay, let's proceed to number two. The capital budgeting decision process addresses letter A is wrong, how a firm's day-to-day financial matters should be managed. No. Letter B, which productive assets a firm should purchase. So basically, this is another way of wording your uh, capital investment decision process. Okay, so the answer here would be letter B. The sources of financing is not the principal issue in capital budgeting. Again, the answer here would be letter B. Number three, which of the following statements is not true in regard to capital budgeting? So meaning three out of these four statements would be true. Capital investment decisions should be consistent with organizational strategy. Obviously, that's a correct statement. Letter B, the process includes controlling capital investments. That's basically what we're trying to do. We're trying to control the investments in a way that we would only be choosing uh, value adding investments. Letter C, decisions involve a range of examples from automated machinery to research and development. That is true. Letter D is obviously the false statements here. Calculations are based on precise estimates of future events. Here we are using a lot of estimates which are obviously not going to be precise. Okay, again, the answer here is letter D. Number four, which of the following is not true about capital budgeting? So hopefully with these questions, you will be able to have some level of mastery as to what capital budgeting really is. So letter A, capital budgeting involves identifying projects that are consistent with organizational strategy. That's correct. Capital budgeting involves long-term projects requiring significant capital investments. Okay, that's correct. Uh, Letter C, capital budgeting allows an organization to reverse a capital investment decision at any time. This is incorrect. Uh, Well, it's possible for us to terminate a project. However, the initial decision cannot be reversed. If you have already made the investment, then that would be considered as sunk cost already at that point. So it would be wrong to say that in capital budgeting, you are allowed to reverse a capital investment decision at any time. You can end, you can terminate early, but you cannot simply reverse what you have already done. You cannot undo what you have already done. Okay, number five, the stage of the capital budgeting process which distinguishes which types of capital expenditure projects are necessary to accomplish organization objectives is the this is basically the definition of your identification stage. Okay, so a lot of questions could be asked on the definition of the various stages of the capital budgeting process. Number six, the stage of the capital budgeting process, which explores alternative capital investments that will achieve organization objectives, is the search stage. Okay, if you're exploring alternative investments, then that means you are at the search stage. Number seven, of course, do not expect the questions to be arranged, class. You have to know the definition or uh, the step or the process behind each of these stages. Number seven, the stage of capital budgeting process, which considers the expected costs and the expected benefits of alternative capital investments. This is your information acquisition stage. So here, answer is letter C. Number eight, the stage of the capital budgeting process, which choose projects for implementation, is the selection stage. Okay, if you're choosing already, then you are at the selection stage. Number nine, the stage of the capital budgeting process in which projects get underway and performance is monitored. This is the implementation and control stage. Number 10, capital budgeting emphasizes two factors. And what are these two factors? Quantitative and financial. Okay, if we are doing the capital budgeting or capital budgeting uh, process, we'll be focusing on quantitative information. That's why we're using cash flows. Okay, quantitative and financial factors. Okay, we've mentioned earlier if you'll be using other factors, if you will be using non-financial qualitative factors, uh, that would not be under capital budgeting. That would be under your scenario analysis, your Monte Carlo simulation. Okay. Uh, but not under, if we're talking about capital budgeting, it's quantitative, quantity, meaning numerical and financial information in terms of money. Number 11, which of the following are not included in the formal financial analysis of if capital budgeting program? Answer is A and B are not included, so the answer is D. What is considered would or included would be your cash flow. Answer is letter D because the correct uh, factor here is your cash flow. Number 12, capital budgeting decisions generally initially have more of an impact on the long-term asset portion of the balance sheet. Okay, so the disbursements here would lead to investments in long-term assets. So the impact would be more on the long-term asset portion of the balance sheet. Okay, so again, a capital budgeting decision generally involves an investment in an asset, okay, which will generate a future cash flow. Okay, and the cost of the investment in this asset, or in our example, equipment, would be initially capitalized, which would be reported in the long-term asset portion of the balance sheet. Okay, so again, this would lead to increases in long-term asset section of your balance sheet. Number 13, capital budgeting decisions are generally initially have more of an impact on. Sorry, where are we? Number 13, capital budgeting is critical for all of the following reasons. Except it focuses on the purchase of assets that will be sold within 1 year. Okay, this is false. If we're talking about capital budgeting, it would be a multi-year project. Okay, so definitely the assets that are involved here are not expected to be sold within 1 year. So the answer here would be letter A, and this would mean that B, C, and D are critical. Uh, are reasons why capital budgeting is critical. Okay, the firm loses some flexibility in its ability to invest in other assets because again, the commitments to make capital investment is significant. So you would lose some flexibility once you have already decided to invest in a particular or specific capital project. A firm's assets defines a firm's strategic plan. That's true. And capital budgeting requires forecasts of revenues over the assets life. Number 14, all of the following are stages undertaken in developing a capital budget for a project except uh, stages undertaken in developing a capital budget. Okay, you will determine the initial investment, the incremental operating cash flows, and the terminal cash flow. The terminal cash flow is the cash flow at the end of the project. Uh, Investment tax shield is not among the factors considered in capital budgeting. Number 15, which of the following is the correct order of the stages undertaken in developing a capital budget? Okay, again, as I've mentioned, terminal cash flow is the cash flow at the end, so that should be at the end. If you look at the choices, the one that has terminal cash flow at the last is either B and D. Okay, so our answer would either B and B. Then, of course, the first would be the initial investment. Okay, both has initial investment. And then you will have the increase in working capital. As what I've told you, your uh, total investment at the start would include the changes in your working capital, the increase in your working capital. Letter B is wrong because when we say release of working capital, this is now the time that this is now the one I mentioned wherein you will be able to recover the investments you made in uh, your working capital. So the release of working capital should also be towards the end. Okay, so that means the answer here should be letter D. You start with the initial investment, followed together with the increase in working capital and incremental operating cash flows, which would be present and relevant on the first and subsequent years. And then towards the end, you will have the release of the working capital or the recoupment of the working capital. And lastly, the terminal cash flow. Number 16, all of the following should be included in the initial investment stage of the capital budgeting process, except letter answer here is letter A, installation cost of the old machinery. At the point of the new investment, the installation cost of the old machinery is already a sunk cost, and therefore it should be ignored. Okay, of course, the installation cost of the new machinery should be part of your initial investment. However, the after-tax proceeds from the sale of the old machinery would be included in the analysis because this would the decision to sell the old machine and replace it with a new one uh, would provide you with possible tax benefits or tax savings. For the same reason, sales tax paid on the new machinery would also be included as part of your initial investment. So again, the answer number 16 is letter A. 17, which of the following would not be included in the calculation of the initial investment stage of capital budgeting? The cost of the new asset, of course, always included. Letter B, incremental cash operating expenses. This is relevant in capital budgeting class, but this is not part of your initial investment stage. Okay. Again, as what I've mentioned, your incremental operating cash flows will be for the operation of the project already, which would be for year one and year two until the end of the project, but not at the initial stage. Okay, not at the initial investment stage. Installation costs, obviously, part of the initial investment stage. And again, after tax proceeds from the sale of the old asset would be relevant as well. So the answer number 17 is letter B. Number 18, which of the following is included in the calculation of the initial investment stage in capital budgeting? We're still in the initial investment stage. Answer is included. So after tax proceeds from the sale of the old asset. Okay, answer is letter C. Number 19, all of the following would be included in the calculation of the incremental operating cash flows except uh, letter A is included, incremental cash revenues, obviously. The depreciation of the old machinery would be completely irrelevant already, so it will not be included. It should be totally ignored. Okay, and it should not be part of the, it should not be considered at all. At this point, the old machinery would be out of the picture already. So again, answer number 19 is letter B. Number 20, company operates. What's the question? Which of the following is the most appropriate time period for the capital budget for the evaluation of the capital investment? A company operates on a calendar year but maintains 4 continuous quarterly budgets for up-to-date budget information, quarterly budget. After completing its 5-year long-term plan, the company's management decided to make a capital investment in new equipment. The equipment is expected to have a useful life of 9 years. Which of the following is the most appropriate time period for the capital budget for the evaluation of the project? So it should be the 9 years. It should be the life of the project for you to make a complete analysis of the or evaluation of the capital investment. So the answer number 20 would be 9 years. 21, the company is considering 2 mutually exclusive capital projects. When it says mutually exclusive, that means you will just have to choose one. If you choose already project A, you can choose project B. Okay. The opposite for mutually exclusive projects would be your what do you call this one? I forgot the term. Okay, maybe we'll encounter it later on. But again, if it says mutually exclusive, that means you can only choose one. So in that case, you will have to choose the best project. You will have to choose the project that will give the most value. Okay, so management would like to evaluate both projects based on financial return, risk, and qualitative measures. What would you recommend management do to help them decide between their two options? So if we're talking about financial return, the best uh, capital investment tool would be your net present value analysis, okay, or your NPV analysis, okay. Out of all these assessment tools or evaluation tools, the net present value analysis is considered to be the superior one. Okay, so with that, we can say that the answer is already letter D. Okay, and if we're talking about risk, then you can be using the Monte Carlo analysis. And of course, for qualitative measures, you can be using brand analysis. 22, the company is budgeting for a capital investment that is required for regulatory reasons. Unfortunately, this project will be expensive and unlikely to improve profits. What recommendation would you make to management as they proceed through the capital budgeting process? Uh, Letter A would be incorrect. Letter A would be incorrect because again, uh, this is not an issue about money. This is not an issue of having more money or generating more money. The issue here is for compliance. Okay, so even if the result of the analysis is negative, you will still have to choose because this is required by regulation. So the best option here would be to explore the cost efficiency of the different options. You will choose the most cost efficient option out of all the required out of the out of all the projects that would satisfy the regulatory requirement. Okay, so answer for 22 is letter B. Which of the following is a qualitative factor in capital budgeting? The sales price, you're talking about the price, so definitely that's not a qualitative. Incremental operating cash flows, you're talking about cash flow, so obviously that's not uh, qualitative. The hurdle rate, you're using a percentage. So obviously the answer in number 23 is letter C. Number 24, all of the following are qualitative factors in capital budgeting except letter A, the salvage value. Okay, you're talking about monetary amount. And while the three other choices are obviously qualitative factors: environmental impact, legal aspects, and the mission of the company. Number 25, which of the following involves significant financial investments in projects to develop new products? Okay, this obviously talks about capital budgeting. 26, the focus in capital budgeting should be on, uh, answer is number 26 is letter C, expected future cash flows that differ between alternatives. 27, all of the following are major categories of cash flows in capital investment decisions, except we've already talked about initial investments. We've already talked about incremental operating cash flows. We've already talked about initial working capital. Uh, Again, the answer here would simply be depreciation because you know that depreciation would be ignored. But what is not to be ignored is the effect of depreciation expense on your tax expense, which would have an effect on your cash flow. Okay, so again, answer number 27 is letter D. 28, an example of sunk cost in the capital budgeting decision for new equipment is letter B, the book value of the old equipment. Okay, if we're talking about the old, again, that would be irrelevant and it has to be ignored because this is sunk cost. No matter what you decide now, the, the cost of the book value of the old equipment could not be reversed anymore. Okay, but of course, if we're talking about the salvage value, then that's another thing. That's basically what we are able to recover or salvage from the old equipment. So that would provide us with additional cash flow. So the salvage value would be relevant. Okay, but again, the answer number 28 is letter B. 29, depreciation is usually not considered an operating cash flow in capital budgeting because deducting depreciation from operating cash flows would be counting the lump sum amount uh, twice. Why do we say counting the lump sum amount? Because basically your depreciation is just uh, the spread out amount or the amortized amount of your cost of the asset. Okay, your initial investment would include the acquisition cost of the asset, and you will include that in your cash flow analysis at the start of the uh, project. So as part of your initial cash outflow, you will include the cost of the asset. So and that would be a deduction. If you continue to make a deduction in your cash flow as a result of depreciation, then it's as if you are deducting the cost of the asset twice. Once at the start and the second time when you spread it out throughout the life of the project. Okay, so I hope you understand what is meant there when it says it would result in counting the lump sum amount twice. Because again, the whole amount of the cost of the asset is already considered as a part of your cash flow at the start of the project as your initial investment. Number 30, the relevant terminal disposal price of a machine equals the difference between the salvage value of the old machine and the ultimate salvage value of the new machine. So the answer number 30 is letter A. 31, In the analysis of capital budgeting of a capital budgeting proposal, for which of the following items are there no after-tax consequence? Answer here would be letter C. Okay, when you invest in working capital, when you recoup or recover the working capital, or when the working capital is released, there will that would not go to your net income, so that will not have any tax consequence. Cash flow from operations will obviously have an effect on your taxation, because cash flow from operations would normally be subject would lead you to operating income, which would be your taxable, which would result in your uh, tax expense. Gain or losses, again, will have since it has an impact on your net income, it will have an effect on your uh, tax expense. Okay, again, answering number 31 is letter C. 32, in the early 1990s, the company launched an environmental program. Since that time, the company implemented many programs, including designing and constructing its stores to be environmentally conscious. For example, the company paints its roofs white or orange instead of the traditional black roofs that consume more energy. Which of the following would not be qualitative factor that Home Depot might consider when choosing this course of action? Qualitative. A block of environmental protesters bringing attention to the environmental policies. Of course, this would be a trigger to this decision. So, and this is a qualitative factor, obviously. Many of the construction decisions resulted in reduced kilowatt usage on a store-by-store basis. Since this already talks about usage of electricity, which would translate into expenses down the road, this would not be considered as a qualitative factor. So the answer here would be letter B. Human impact on global warming, obviously qualitative. Interest by millennials in working for companies that are environmentally conscious, again, obviously a qualitative factor. 33, the company is considering two different capital investments. The first is to upgrade the software so that sales, purchases, and production are all integrated. The management team projects that the company will decrease operating expenses by over 20%, starting almost immediately after implementation. The second investment opportunity is to install a new paint line that uses a powdered coating instead of oil-based paints. This project will enable the company to meet expected new regulations that limit the disposal of uh, paint waste. Okay, so the investment for the operate. What is the primary purpose of each of these projects? For the operating software, obviously it is operational. If it involves your operating costs or your operating revenues, then that would be the primary purpose there would be operational. For the paint plan, obviously, since it is to comply with regulatory requirement, then that would be your regulatory. So the answer number 33 would be letter C. 34, uh, the company, a small law firm specializing in litigation, is planning on implementing the following projects. So you're just asked which of these four projects can be considered as a capital project. Okay, let's start with the first one. New software. Okay, it's an investment in new software, and it will help you automatically track and bill the time and expenses. Uh, this include this involves a significant sum of money. And definitely the benefits here would go beyond 1 year, so these can qualify as a capital project. Furniture, obviously, long term and involves significant sum of money, so that would also be a capital project. The sign, uh, the sign will be expected to be used for more than 1 year, and if you look at the price compared to the others, it is a significant amount, so this can qualify as a capital project. So for these kind of questions, class, take into account the purpose of the project, the periods that will be benefited from the project, and of course the amount of money involved. To repair the roof, obviously this would also be capital project. Not only does it make an improvement, it even extends the life of the roof. So all of these projects involve significant sums of money, and it also uh, affect more than one reporting period. So the answer here would be all these four. So you will just add these four. 48 plus 20, that's 68,500 plus 22, that's 868, 90, 900, and you add 12,750, you will have 103,650. So the answer here is letter A. Number 35. What's the question? What would you recommend management do to help them decide between these two options? The answer here, class, would be to calculate the net present value in both projects and select the one with the highest net present value. Since you're choosing only one, I would assume that the problem tells us that the projects are mutually exclusive. Yes. In the last paragraph, it says, unfortunately, the company cannot afford to invest in both capital projects. Okay, number 36, which of the following is not a benefit of conducting a post audit as a final stage of the capital budgeting process? Which is not. Letter A, a formal process is established to evaluate an implemented project in order to continue to optimize management decisions with respect to the project. That's a correct statement. Letter B is the answer here. It says upper management is able to hold managers absolutely accountable for project estimates that vary from actual results. Okay, there are no absolutes here, again, because we are using estimates. Letter C and D must be correct statements. Control over the use of project funding and progress are enhanced. That's true. Managers obtain feedback. Obviously, that's true if you conduct a post audit uh, procedure. 37. Which of the following is not a characteristic of a capital budgeting post audit? Uh, Letter A, post audit should motivate managers to build slack. No, with because of the feedback, uh, it would be very easy to circle back to your managers if ever they are not uh, honest in preparing the projections. Okay, so definitely it would discourage managers from building slack into their capital investment projections. So the answer here would be letter A. 38, comparison of the actual results for a project to the costs and benefits expected at the time the project was selected is referred to as, okay, basically the definition of your post audit, or here letter C, a post investment audit. 39, management accountants engage in many activities that are key to the capital budgeting process. Which of the following activities would not be an accounting function contribution? Gathering relevant revenue and cost data needed. Okay, that's provided by accounting function. Conducting sensitivity analysis. That can also be part of accounting function. Identify the technology options available when the company is considering converting to advanced manufacturing process. No, this would already be outside the scope of the accounting function. So answer number 39 is letter C. Number 40, construction firm is evaluating two projects that are cash flow positive. The first project deals with building access roads to a new terminal at the local airport. The second project is to build a parking garage on a piece of land that the firm owns adjacent to the airport. The firm's decision will be to uh, accept both projects because they are independent projects. Answer is letter D. This is the one I mentioned earlier. The opposite term for mutually exclusive projects, you have independent projects, meaning they can proceed independently. Okay, so you can either accept both or reject both. For mutually exclusive projects, you can only accept one. If you accept one, you will have to reject the other. 41, goal congruence focuses on consistency between a company's goal and its employees' goals. To effectively and efficiently pursue its strategy, it is important that everyone in the organization choose actions consistent with its strategy. Which of the following would not be a tool to address the problem of a lack of goal congruence? Letter A, redesigning the control system to include a multi-dimensional evaluation system. With that, you can actually, that would improve goal congruence. Evaluating investment proposals using tools such as economic value added that include an imputed charge for invested capital. That would help goal congruence because everyone would be using the same basis. Conducting post implementation audit. Okay, goal congruence would be one of the benefits of post audit. So the answer here must be letter D, increasing the strength of the linkage between budgeted capital investment performance and incentive compensation. Okay, if you link your incentives with the uh, performance of the budgeted capital investment, then each manager would be looking out for their own uh, benefits. So everyone would be selfish, which would lead to lack of goal congruence. Their goal would be individualistic already and not for the good of the company. 42. The company has been in business for 4 years. Last year, company managers created their first capital budget. They started by identifying and defining various projects that management would like to invest in. They then evaluated their options and selected a project. They are now ready to begin the process again. However, the company controller is concerned because last year's project ran over budget and took much longer to implement than was planned. What would you recommend the company do differently this year? Uh, this is a good opportunity for you to conduct a post audit, which is which would let you monitor and review the project. Okay, or even you can even perform the review, the monitoring and the review while the project is in progress. And I believe this is even the third step of the uh, capital budgeting process. Number 43, similar problem. Let's see if anything is different. Planning to spend on capital projects that have a strategic purpose. Okay, so we're not simply going to identify whether they are capital projects or not. We will be determining whether the purpose is strategic or not. Okay, you have to remember that for it to be considered for a strategic purpose, the capital investment must be designed to strengthen the company's competitive position. Okay, it is for a strategic purpose if it strengthens the company's competitive position in the marketplace. Let's see. Uh, uh, the new software would be more on operational, not strategic. Furniture, since it is for the reception area, this can be considered as strategic because this would help your relationship with your customer. The same for the sign. Okay, the roof would not be so much as strategic. So your answer here would be the sum of your furniture and sign investments, which would be 2,500 and 22,400, and that is 42,900. Okay, so again, strategic investments would include objectives that would strengthen relationships between your customers and improving the brand of the company or the image of the company. 44, identify which ones are capital projects. Uh, the new equipment, obviously, the new equipment is obviously a capital project. And then the repair is even for a recurring problem, obviously not a capital project. Landscaping, very minimal amount. So this would not qualify as a capital project. The research and development, significant amount. Okay, and it would expand flavor options. Okay, so that can qualify as a capital project. So our capital projects here would be the first and the fourth one. So if you add the 245 and 32,700, that would be 77,700. The answer number 44 is letter C. 45, I think we will have to solve now. The company's capital structures include 2 million face value of 8. Let's read the question first. Calculate the company's percentage of equity to use in calculating the weighted average cost of capital. Again, you will be talking about weighted average cost of capital a lot because that would be used as your hurdle rate. But unlike in your finance subjects, the computation of weighted average cost of capital here would not be very difficult, would not be very bloody. In your finance subjects, for your average cost of capital, you will solve the cost of debt. And in solving for the cost of debt, uh, you will take into account the tax rate, and you will be the one to solve for the effective rate of return on your bonds. Okay, and then for your cost of equity, you would also be considering the cost of your new issuances or the cost of uh, your retained earnings, and you will also have the cost of preferred shares. But normally in the CMA exam, those things would already be given, and all you will have to do would be to simply assign the weights and already solve for the weighted average cost of capital. Let's see. But here we are not asked for the rates, we are asked for the percentage or the weight for equity. And that you will just have to look at the capital structure of the company. Okay, so here the capital structure includes 2 million face value, 20-year bonds with a current market price of 110. The company also has 300,000 shares of common stock outstanding with a current market price of 26 per share. Okay, how much is 300,000 shares times uh what's this, 26, 300 times 20. So that would be 7,800,000. And then your bonds, the face value is 2 million, but the market rate is 110. So you multiply this by 110%. So that would give you 2,200,000. Okay. So your debt is 2,200,000 while your sorry, current market price 300 times 26. That's 7,800,000. And then um, your debt Your debt is price of 110. So 2,200,000 plus 7,800,000. So your total capital would be 10 million. So the sum of your debt and capital is 10 million, and your debt, your equity represents is 7,800,000. So 7,800,000 divided by 10 million, percentage wise, you will have 78%. So the answer in number 45 would be 78%. 46, the company's capital structure. Say, this time we're asked to solve for the weighted average cost of capital. So we'll be using 78%, and the weights would be 78% for equity, 22% for debt. Since we already have these two, multiply these weights with the uh, cost of debt and cost of equity. For cost of equity, it says here that it is 11%. So you just multiply 11% by 0.78%, or multiply with 78% the weight of your equity. So you will have 8.58%. But that's not the WACC, that's just the weighted cost of equity. We have to add the weighted cost of debt. And our debt is at 8%. Okay, given in the problem. Okay, and the weight is 22%. But you have to remember, if it's debt, you will have tax savings. So the cost there would be a lot cheaper. So you'll have to deduct the tax rate of 25% or simply multiply it by 75%. Okay, you will have the weighted after tax cost of debt would be 1.32%. Then you add that with our 8.58 earlier, representing the weighted cost of equity, you will have 9.9%. Very important thing to remember in getting the weighted cost of your debt, the cost of debt must be after tax. So if before tax cost of debt is 8% and you know that the tax rate is 25%, 1 minus 25%, the after tax portion would just be 75%. So multiply 8% by 75%, you would have 6%. Then multiply that with the weight of 22%. That's how we got the 1.32%, which we added to our 8.58%, which gave us our answer of 9.9%. 47, let's skip this one. The answer here is, uh, let's see. Uh, the first project is to upgrade the software system so that sales, purchasing, and production are more tightly integrated. Management is aware that since we'll have to answer this one. This is not a repeat question. As a result, they have asked the software provider to issue a flexible quote around uh, a plan for implementing the software in steps so they can schedule payments and training around any unforeseen delays. The second project is to upgrade the paint line to one that uses a powdered coating instead of oil-based paints based on current needs. Management requires a 6-foot square paint booth. However, they are anticipating demand to increase and foresee that a larger paint booth may be required. They asked the provider to also quote both a larger paint booth as well as the cost to add on to the 6-foot square booth. What real options for each project is management building into the capital investment? So obviously, for the paint line, they are uh, designing it that they would have the option of expanding. So for the paint line, it's going to be expand or contract, and then for the software system, obviously, it's not to discontinue or abandon, it's to simply slow down or postpone. So the answer in Letter D would be, sorry, the answer number 47 is letter D. Let me just check if I'm still recording. Okay, let's proceed to number 48. Okay, you analyze number 48 class. The answer here would be letter A. Okay, just make sure to read the problem. 49. Uh, Question here, which of the following is an operational purpose? Customer information is not operational. Implement text messaging, not operational. Offer customer rewards, not operational. Ability to track sales, obviously that is the one that relates to operations. So the answer number 49 is delta. Okay. An operational purpose again is one that focuses on either reducing operating cost or increasing revenue. Okay, lower your cost or increase your revenue. Number 50. Okay, so this is just another variation of the a problem you've already answered. Number 50. Uh, let's see. The first project is to upgrade the software system so that sales purchasing. So this would be operational. The second project is to upgrade the payment to the one that is powdered. Uh, the engineers project that the company will save over 100. So both would be, sorry. Sorry, the paint line would be operational since it has something to do with your cost, but the software system would not be operational since it pertains your competitive advantage. Then that would be strategic. So the answer number 50 would be letter A. 51. Answer for number 51 is letter B, the ability to offer customer rewards for frequent purchases. Number 51 asks for a strategic purpose. Again, strategic purposes. The purpose is to strengthen the organization's competitive position. Okay. So that's why the answer is letter B. 52 answer is to run a Monte Carlo simulation analysis. Okay, because we use the Monte Carlo simulation analysis to see what possible returns may be under a variety of circumstances. Okay, so it helps you analyze risk. Number 53, what if technique that examines how a result will change if the original predicted data are not achieved. This is your sensitivity analysis. Okay, and then 54. Which of the following statements best describes the likely impact that an abandonment option will have on a project's expected cash flow and risk? 54 answer is letter B. Expected cash flow increases and risk decreases. So if you have an option to abandon, then you would be able to choose the option that would give you more cash flow, and because of this option your risk would decrease. Okay, the risk of operating it at a loss would be reduced because before it reaches the point of becoming a losing venture, you will already be able to exercise the abandonment option. 55. Which of the following statements best describes the issues that the company faces when considering the investment timing option? Letter A is wrong. The investment timing option does not affect the expected cash flows. The Your real options, not just investment timing options, would affect your cash flows. Okay. The more uncertainty about the project's future cash flows, the more likely that it is for the company will go ahead with the project. Of course, that's incorrect. The more uncertainty, the least likely we are to pursue the project. Let us receive the project as a positive NPV today. This means that its expected NPV will be even higher if it chooses to wait a year. That's wrong. It's possible that if you wait longer, then you might be losing out on some benefits. So your NPV might become lower even. Okay, so the answer here would be letter E. 55 is letter E. 56, which of the following is an example of a flexibility option? Answer in number 56 is letter C. A company pays a higher cost today in order to be able to reconfigure the project's inputs or outputs. So you're paying more just for you to have more flexibility. Letter A here describes investment timing option. A delay or postpone. A company has the option to back out of a project. Letter B describes your abandonment option. Letter D is also again a investment timing option. Number 57. Which of the following is an example of a flexibility option? Answer here is letter C. Oh, I think that's the one we. Is 56 and 57 the same? Okay. 58. Wayland regularly takes real options. Please make sure to go over this question. Answer for number 58 is letter B. The abandonment option tends to reduce a project's risk. Let's try to go over the questions quickly, class. 59. Capital investment. Answer for number 59 is letter D. Invest additional advertising on a movie release only if opening day sales exceed the set limit. Here, you're already making decision based on the options available to you. Number 60, Harmon. Answer is letter B. The abandonment option is likely to increase the project's expected cash flow. 61. Which of the following statements is most correct? Uh, Answer here is letter A. In general, the more uncertainty there is about market conditions, the more attractive it may be to wait before making an investment. Okay, so that means B and C are false statements. 62, Seaver is considering investing in Hong Kong. Which of the following factors would make the company more likely to proceed with the investment? Answer here is letter D, A, and B. Uh, the company would have the option to withdraw from the investment. If you have a withdrawal option, then that would make the project more desirable. The investment would increase the odds of the company being able to subsequently make a successful entry. So, some sort of an expand option. So that would make the project also more desirable. Again, the answer there is letter D. 63. Which of the following statements is most correct? Answer here is letter D. A and B are true. If you have an option to abandon a project at a later date, this increases the likelihood that you will select the project today. Yes. Letter B, when evaluating potential projects, you always include opportunity cost in the estimated cash flows. Yes. Letter C is obviously wrong because, again, as what we've said, sunk costs should not be considered. 64, which of the following are not real options? Answer here is letter B, the option to buy additional shares of stock if the stock price goes up. Okay, this is not among the real options contemplated in capital budgeting. You have the expand option in letter A and C. You have the abandon option in D, and the flexibility option in letter E. 65. Which of the following will not increase the value of a real option? Answer here is letter D, an increase in the cost of exercising the real option. The contrary would happen. The value of the option would decrease as a result of letter D. So that's why that is the answer. 66. The answer for clueless is letter A. Its estimated capital budget is too small because it fails to consider abandonment and growth options. 67. Hopefully, this will not come out. The answer for number 67 is letter C. Capital budget is 870 million, larger using White's approach. Uh, make sure to answer 87. I mean 67. 68. Which of the following statements is most correct? Answer is letter D. A and C are correct. The rate of depreciation will often affect operating cash flows. That's true. Even though depreciation is not a cash expense because of your tax savings. Letter B. Corporations should fully account for sunk costs when making investment decisions. That's false. Corporations should fully account for opportunity costs. That's true. So the answer is letter D. Statements A and C are correct. 69. A company is considering a new project. Answer number 69 is letter C. Any opportunity costs associated with the project. All the other choices are not relevant. 70. When evaluating potential projects, which of the following factors should be incorporated as part of the project's estimated cash flows? 70. Answer is letter D, B, and C. Okay, opportunity cost and externalities. Okay, sunk cost again must be ignored. 71. Which of the following statements is most correct? Answer is letter B. When evaluating corporate projects, it is important to include all relevant externalities in the estimated cash flows. 72. Which of the following is not a cash flow that results from a decision to accept a project? Obviously, the answer here is letter C. Again, ignore sunk costs. 73. When evaluating a new project, the firm should consider all of the following factors except uh, letter B, previous expenditures associated with the market test to determine the feasibility of the project if the expenditures have been expensed for tax purposes. At this point, letter B is already a sunk cost, so it should not be considered. Okay. And then 74, which of the following items should the company take into account in evaluating a proposed prune juice project? Answer here is letter D, B, and C. So this would just be recurring theme class. Letter B would be from your incremental cash flow. Letter C would be your also for your incremental cash flow. Letter A is not among the correct answer because this would be uh, sunk cost. Okay, again, this is a recurring theme. Ignore sunk cost. Very important. Ignore sunk cost. If you can only remember one thing from this decision, let it be that you are to ignore sunk costs. 75. Which of the following should a company consider in analysis when evaluating a proposed project? Answer here is letter D, A, and B. The new project is expected to reduce, again, incremental cash flow. Uh, letter B, form of externalities. Letter uh, C would be sunk cost again. 76. Answer there would be letter D. Statements A and B are correct. 77, answer there is letter A. 78, answer there is letter A. 79, answer there is letter B. Number 80, answer there is letter E. 81, answer there is uh, letter B. 82, answer there is uh, letter B. Make sure to solve this one, class. 83, uh, answer is letter C. And lastly, 84, finally, answer is letter C. Okay? Uh, Hopefully you'd be able to remember the answers to these questions. Okay?